Hello there, my name is Jawad from Jadid Institute. Today we're going to solve an Igcse accounting MCQ paper 1-1 from May-June 2021. Before we start, I would remind you to hit the subscribe button for more videos and share this video with your friends if they are studying the same subject, right? It might help them out. Number 1. Which statements about bookkeeping and accounting are correct? You need to know the definitions of both. Bookkeeping is the detailed recording of day-to-day transaction. Accounting uses the bookkeeping records to prepare financial statements. Accounting is performed periodically rather than daily. That is true by definition. We don't prepare income statement every day, right? We need that every quarter or normally in your syllabus yearly, right? It relies on accurate bookkeeping records. That's true. If bookkeeping records are inaccurate, the profit and the rest of the financial statements will be inaccurate, of course. Bookkeeping includes the preparation of financial statements? No, quite the opposite. Accounting does. Bookkeeping involves the recording of financial transactions. By definition, that's true. 1, 2, and 4 is our answer. A. Let's move on. What increases owner's capital? Bank loan extended from 5 to 10 years. Loan is loan, right? Bank loan is a liability. Purchase of inventory on credit. What's happening here? You can imagine accounting equation, assets equal capital plus liabilities. What's happening in this case? Purchase of inventory on credit. Well, there's a new liability being created because you're buying on credit and you have some new assets. So nothing to do with capital, right? Purchase of machinery by check. One asset going down, one asset's going up. Bank cash at bank going down, machinery going up. Doesn't affect your capital. No. Transfer of vehicle from business to business from private use, and that is called capital introduced. That's going to increase owner's capital, right? Capital introduced gonna increase owner's capital, right? D is the answer. Another example of what increases owner's capital: profit. Profit increases owner's capital. Loss decreases owner's capital. Question number 3. Carl, a trader, took goods from the business for his own use. Drawing of goods. These goods had cost $100 and $8 carriage had been paid for them to be delivered to the business. That's carriage inward, right? It goes hand in hand with the cost of goods. You should know that. Even if when valuing inventory, you know that. How do you come to the final cost figure? Purchase cost plus any cost of bringing in the goods. That is a carriage cost. So essentially, these goods cost $108 for valuation purposes. How would this be recorded in Carl's book accounts of? Sorry. How would this be recorded in Carl's accounts in the books of the business? Okay, so it has something to do with drawings being debited, right? Drawings are debited. By how much? By 108, because that's the value of those goods, not just 100. That's how you value inventory, isn't it? Number 4. Shula's financial year ends on 31st March. On 1st April 2021, there was a credit balance of $100 on Yasmin's account in Shula's purchase ledger. So we're looking at Shula's perspective. Now look, my advice to you is to always define the relationship. Who's the supplier? Who's the purchaser, right? So Shula's purchases ledger. So Shula is the customer, right? And Yasmin is a supplier. And now once you define that relationship, it's going to help you out. What does this mean? Okay, let's look at that again. There was a credit balance, $100 in Yasmin's account, the supplier account. So Shula, the customer, sees Yasmin as a payable, right? Now that is a payable amount because Yasmin, the supplier, of course, is a payable for Shula. Purchase ledger contains all the payable, all the supplier's accounts. Suppliers are liabilities. Okay, Shula had paid. No, it's not the payment, it's the balance. Balance is not the payment itself, right? That would be the bank entry, in your T account. You'd see bank amount, not the balance brought down. Shula owed 100 to Yasmin. That sounds right to me because, again, Shula is the customer. The credit balance from Shula's perspective, credit balance means the liability. All the liabilities have credit balance. Shula owed $100. That's correct, actually. Yasmin had paid. No, it's not about payment. The balance is not payment, right? Yasmin owed Why would Jasmine owe as a supplier? You see now, just by defining the relationship, you can tell what's the answer, isn't it? Of course, a customer would owe, in a normal case, a customer would owe supplier, right? Owe to supplier, isn't it? Next one, 5. Okay, that's done. 4 done. 5. Hasina buys radios from Nazneen at a list price of $10 each. Again, what did I tell you about you know two different parties involved? Define the relationship. Hasina buys radios, the customer, supplier. That's gonna help you out. At a list price of $10 each, Hasina bought 12 radios and was offered 20% trade discount, 4% cash discount. 2 radios were faulty and were returned to Nazneen. Okay. What was the total of the credit note issued by Nazneen? Right. So you should know that when you buy or sell goods with a trade discount at the time of transaction, at the time of selling, you would give your customer a discount. As a seller, you would give a discount. But when those goods are returned, you would also deduct the discount from the list price. You won't refund, right? The whole amount. And also remember that in this particular case, there's a credit note issued for just the 2 of those radios. So we don't have to do any calculations. We just have to look at the list price of the 2 radios, which is $20, right? The 2 radios, $20. That's the list price. However, originally, at the time of transaction, 20% trade discount was offered. So while returning also, you have to apply 20% discount. And that's going to be $4, right? And $16 will be the credit note issued. Is that correct? What do you think? It should be correct, right? Yeah, let's move on. Number 6. Which items would be recorded in the general journal of a bakery? Which items would be recorded in the general journal of a bakery? Correction of an error of principle relating to an oven repair. Why not? Correction of errors, they are recorded in general journal. Purchase of a delivery vehicle on credit. Yes, we're purchasing an asset on credit. It's not like we are purchasing goods on credit. Purchasing goods for resale on credit would be just purchases journal. But this is something else, right? Purchase of flour on credit. Now you see that will go into your purchases journal, isn't it? Because that's goods for resale. That's raw material that you will be selling further on. Number 4, return by a customer of a faulty batch of bread. Okay, that's a sales return, and that goes into sales returns journal, right? It can, yeah, it should go into sales return journal. Yeah, if it was, even if it was sold on cash, it would be cash book. If it's sold on credit, then it's sales return journal. So it has nothing to do with general journal. The answer should be A. Number 7. Alicia entered the credit notes she received in March in the correct returns journal. She received the credit notes means that was purchase returns for her, isn't it? Because that's credit note received. Remember, credit notes are always issued by the supplier and received by the customer. That's what tells me that Alicia is the customer in this case. How was the total of this journal recorded in the ledger at the end of the month? So we know it's first of all purchase returns. Part of it was already figured out. And you should also know that purchase returns are always credited, right? Whenever there's a purchase return, that account is credited. Purchases account is debited when you make purchases. Purchase returns account is credited when goods are returned. Which item would not be shown on a bank statement? A check returned by the bank marked as refer to drawer. A monthly payment made for electricity by direct debit. Okay, bank charges, unpresented checks. That won't be given on the bank statement. Because, unpresented checks are not yet presented. What does that mean? That's why you put that in bank reconciliation. That means that you made payments with your check, you use your check to make payments, and they are still with the people, right? With the people who you made the payments to. So you have a supplier, let's say you give them a check, and they've still not presented it to the bank. They haven't given that check to the bank yet. And so bank doesn't know about it. How would that appear in bank statement? Okay. The first one, I believe they're trying to say that it's dishonored check, right? It's a dishonored check, and yeah, a monthly payment. So all these things appear in the bank statement because bank knows about them, while the bank does not know about them. So how would that appear in bank statement? It won't. Which statement about number 9, which statement about a purchases ledger control account is not correct? Purchase ledger control account, another name for that is total trade payables account. Okay, it acts as a check on balance of purchases account. Actually, it doesn't, right? I think that should be correct because it actually checks as a balance. It acts as a check on the on the total of individual trade payables or the individual supplier accounts, right? I believe this should be the answer. Let's have a look at other options. It includes transactions relating to all credit suppliers. That's true. It is prepared using books of prime entry. That is also true. It provides proof of arithmetical accuracy of, and that's also true. That's the whole thing. That's the whole idea. So purchase, not the purchase account, but the purchase ledger. All the accounts in the purchase ledger, you must know the relationships, guys. If you don't know that, then you need to revise your book because that's the whole concept, right? We can't get into that in this little video. You must revise your topics if you're confused between purchase ledger and purchase account, and you know what I mean? Like, just go through that again if you have some doubts. Number 10, Javeed's sales ledger control account had a debit balance of 12,000. That is total trade receivables account. It had a debit balance of 12,000. Interest on overdue account $40 and discount allowed 140 had been omitted. Okay. Now, that's going to increase our receivables and that's going to reduce our receivables. Does that make sense? You see, that's why it helps to look at it in terms of receivables and payables. So they have simply given us sales related control account, but we look at it as total trade receivables because that's what it is. And when you look at it from that angle, you realize that, well, interest that you charge will increase our receivables. We're going to receive that money, and the discount you allow will reduce your receivables. You won't receive that money anymore. So you subtract that. So it helps us think better. What was the correct balance on the sales? Well, let's just do the calculations. 12,000 plus 40 minus 150. 11890. What is the effect of treating an item of capital expenditure as revenue expenditure? Okay, so capital expenditure is mainly purchase of an asset, non-current asset, while revenue expenditure is mainly just a regular day-to-day expense, right? Which is the main difference, well, I was trying to point out was this goes into income statement, this goes into statement of financial position. As an expense, as an asset. That's a huge difference. Okay, what is the effect of treating an item of capital? So you treated an asset as an expense. What's going to happen? Cost of non-current asset is overstated? Not at all. It's the opposite. Cost of non-current asset is understated, right? Depreciation for the year is understated as well because you have ignored some of the non-current assets, so you haven't taken any depreciation on that, isn't it? Although the expenses are way overstated because you counted an asset as an expense. Expenses are overstated. However, depreciation is, some of the depreciation is understated because some of the non-current assets are understated. Right? These both are directly related. All right, 2 and 4. D. Let's move on. Number 12. Why does a business provide for depreciation on non-current assets? Let's see. It's a repeated type of question. Please make sure you know the answer to this. Also, pause the video and attempt each of the MCQs you're doing. Then you can look at the answer and explanation. To charge the cost of non-current asset against profit in the year of purchase? No, that's not the whole. That's completely opposite of what we're trying to do. We're trying to spread the cost, not to include it all in the year of purchase, not in the year of purchase, throughout its useful life. That's the whole idea of depreciation. No. To ensure that non-current assets appear at book value in the statement of okay, that is true. That is true. Well, there's nothing wrong with that. I don't see anything wrong with it. Let's see if we have a better option. Otherwise, this is it. To ensure that matching principle is applied when preparing financial statements. And okay, that's also not bad. To retain cash in business for replacement, not at all. Now that's one confusing point they always try to give you. This is definitely not the answer. It's not like we are collecting money for future purchase, not at all. Let me read that again. I might have missed out some detail. To ensure that non-current assets appear at book value in the statement of financial position. Why does the business provide depreciation on non-current assets? Well, C looks better to me. To ensure that matching principle is applied, because this is 100% true. Um, what am I missing in B? Because this kind of looks okay, because I don't see anything wrong with it. Perhaps it's not net book value, right? To ensure that non-current assets appear at net book value, that should be the answer, I believe. And so that's why we have to get rid of it, because C is the most convincing one. C is like the definite answer. To ensure that matching principle is applied when preparing financial. That's the whole basic idea. That's definitely true. This is the second priority because although it looks fine, but it doesn't say net book value. To ensure that non-current assets appear at net book value in the statement of financial position. Let's move on. Number 13. Machinery which had cost 62.90 was sold for 3,100. That was the cost. That's the selling price. The disposal account showed a profit on disposal of 584. We made a profit on disposal. Okay. Um, so it means, what does that mean? That means whatever we sold it for, that was 584 more than what was our net book value, right? So this means 3,100 minus 584, that must be our net book value. I'll explain that once again from another perspective. 3,100 minus 584, 2,516. Now you see, that must be our net book value. How does that make sense? Well, see, the cost of machine was that much. That, if let's say that is our net book value, which it is, and we sold it for that much, it shows that the net book value is 2,516 and we sold it for 3,100. That means there's a profit of 584. It all adds up, isn't it? Next, we can find the provision for. Wait, what am I doing? What's the question? Let's just confirm. How much was the depreciation up to the date of disposal, and on which side of disposal account was it recorded? Okay, so the depreciation to the date was 6290 minus 2516, which is the net book value. 6290 minus that is 3774. We know the answer is 3774. Where does that appear on the disposal account? You should know that accumulated depreciation appears on the credit side of disposal account, right? So that's it. Now you can also try to make a little disposal account if you like, a little T account, because that's another approach. We can explore that. Machinery cost was 6290. Now for this you must have some basic idea of how disposal account is prepared at least. It was sold for 3,100, so bank debit by 3,100, disposal account credit by 3,100. And then the profit on disposal. Profit means it's an income. In the income statement, that's credit. On the disposal account, that is debit. 584. And the balancing figure that you see here is going to be 3774 over here. I haven't calculated, but I'm pretty confident with that. So it's going to be 3774, and that is our accumulated depreciation. The double entry is provision for depreciation account. That is the cost, that is the consideration, what we've sold it for, and that is the depreciation. Okay, let's move on. The following ledger account appear in the books of a trader. Rent receivable account. Okay, so it's an income account. Always figure out what's going on, right, guys? Use your pencil, mark that down as well. Don't be afraid to use your paper. You can do some notes on that, no problem. So, what does that show? There's an opening balance. Don't think that these are two opening balances. This is an opening balance. This is closing balance carried down. And it is a credit balance. That means it must be accrued income, right? Sorry, what am I saying? Prepaid income. Prepaid income is a liability. That is a credit balance, it's a liability, and so that shows you it's a prepaid income. Prepaid income is a liability, remember that. Which entry was made in the income statement for the year ended 31st December 2020 for rent? That question is actually easier than I thought. All you have to do is just look, because closing balance is given to you. The missing figure here is the income statement amount, which is going to be 4,000 minus 600, 3,400, right? And 3,400 debit here, and so the double entry will be income statement credit by 3,400. We're done. That's A. Okay, let's move on. If you have noticed, what I do is I don't even read the question, but I get familiar with the question. I get myself familiar with the question. So I advise you to do the same. When you're in the exam, get yourself familiar with the question. That takes like a few seconds, and then you can get into like what they're exactly asking for. Okay, why does a business maintain a provision for doubtful debts account? To apply the accounting principle of prudence, which looks fine to me. It looks like a good option. To avoid profit for the year being understated. No, to avoid profit from being overstated. That's the right way to put it. To have an accurate forecast of debts. Not accurate. This is just an estimate. To reduce the expense of irrecoverable debts. No, it does not reduce the expense. It cannot reduce the expense. It can only consider the expense, the potential expense. To apply the principle of prudence, that's the best option available. Number 16. How should inventory be valued? Cost, NRV, none. Higher of cost, no. Lower of cost and NRV, yes. It's a very straightforward question and a very straightforward answer. Um, by definition, this is the answer. There's nothing to explain. You have to just know the definition. Number 17. What are the advantages of being a sole trader? Easy to raise finance? Definitely not. So A and C are wrong. You see how canceling helps you out? Only B and D are remaining now. Entitled to all the profit? Yes. D is looking good. Has total control? Again, these D and B are both okay. Has unlimited liability? Yeah, that's true. Oh, wait. I was like, well, I was thinking this is one of the properties of Sole Trader. It has unlimited. So I was saying, why is it not there? But then I forgot its advantages, right? So this is not advantage. I was like, this is a property. This is a factor. This is something that a Sole Trader has, unlimited liability. So why is it not ticked? Well, the question is not about just being related to Sole Trader. It's about if it's an advantage. So entitled to all profit and has control. These are the advantages. Although this is true, has unlimited liability. That's true for a sole trader, but it's a disadvantage. All right, let's move on. Number 18. Which items would appear in the income statement of a service business? Of a service business. There's no gross profit in a service business because gross profit appears in the trading account section, and a service business does not trade. So there is no cost of sale and purchases, all of that. No, both are wrong. Now we have 50-50 chances of getting this right, even if you're guessing. So next one, profit for the year. Yes, it has that. Well, we'll just go with that. Let's move on. Surplus. Yeah, profit for the year. I mean, surplus can possibly appear in a service business as well. It's kind of an odd question, but this is an obvious choice. Just go for that. Profit for the year. C is the right option. Let's move on. Number 19. A business provided the following information. What was the total of the current liabilities? Long-term loan is definitely not a current liability. Trade payables, bank overdraft, prepaid insurance, that's an asset, current asset. Accrued wages is a current liability. These are the wages you haven't yet paid. You have to pay them. That's a liability. Rent receivable prepaid. Rent receivable prepaid. Income prepaid is a liability. I said that a few minutes ago. Because you have received some money which you haven't earned yet. You just received that because people paid you. So when you receive money in advance, that's not your money yet. It's a liability on you. You're liable to provide service later on. That's 13,200. Let's move on. What is added to owner's capital to calculate capital employed? I've given you this trick a few times, but I'm going to give that to you again. You remember that accounting equation? Just break it down, non-current asset plus current asset, instead of just writing assets, non-current asset plus current assets, equal non-current liabilities plus current liabilities plus capital. Right? It's just your classical accounting equation that you learned in the first chapter. Assets equal liabilities plus capital, but just break it down. And now the next step is to bring that on the other side. Just subtract the current liability on both sides. Very basic algebra. Non-current asset, sorry, non-current asset plus current asset minus current liability, and that's it. That's the way you find your capital employed. You found your capital employed, either that way or that way. See, they both come from this equation. Just take the current liability on the other side, and these are the two ways you find your capital employed. So, what is added to owner's capital? Non-current liabilities. Okay, the two ways to find capital employed, and they are both the same. The answer is going to be the same. Why is it going to be the same? Because they are both coming out of the accounting equation. Just a different variation of accounting equation. Okay, let's move on. 21. On 1st April 2020, Ahmed had a provision for doubtful debts of 290. The following journal entry was made on 31st March 2021, end of the year. Okay, in the beginning of the year, that's the provision. At the end of the year, there's some transfer. Provision for doubtful debts 25 debit, and income statement credit means when income statement is credited, it means it's an income. So it looks like provision actually went down. Provision for doubtful debts was adjusted downwards by 25. Okay, so provision for doubtful debts deducted from receivables in the statement of final position, well, that's the latest provision, which is 290. It reduced. That's why it was added as an income. It didn't go up. When it goes up, it's an expense. In this case, it's an income. And so that will be 265. Now you can also make a little account, provision for doubtful debts account. It always has a credit balance brought down. In this case, 290 was the balance brought down. 25 was debited because it was transferred to income statement, and then of course 265 was then carried down to the next year. 265. I think you can't see that in the recording here. Okay, you can make a little T account as well if you like. Let's move on. Although it's a straightforward question, not that complicated. 22. X Limited started the year with ordinary share capital of 100,000. An ordinary share dividend of 3,000 was paid during the year. Later, a further 10,000 ordinary shares were issued. The profit for the year was 8,000. By how much had equity increased at the end of the year? Okay, so the profit was 8,000. That's going to increase equity. All right, so in the beginning we just have 10,000, 100,000, okay? What happened during the year? 10,000 more shares were issued, so that increases equity, that increases ownership, or what belongs to the owners, basically. There was more profit, so we're gonna get more money, 8,000. Now 8,000 also belongs to the owners, and 3,000 is taken away. It's given to the owners, but it's out of business now, so equity goes down by 3,000. What belongs to the owner goes down because they've taken the money. So that's gonna be 15,000. Okay, not that hard. Again, if you're facing difficulty here, please revise limited company chapters. This is basic, nothing complicated. Which provides us of funds to a limited liability company receive a fixed rate of return on their investment. Okay, for this you need to know their properties, you need to know, what owner share means, preference share means, and they all have their you know properties, right? And you should know that ordinary shareholders never receive a fixed rate of return. It's always decided by the directors every time. So no, they don't receive. Ordinary shareholders don't receive fixed rate of return. Preference shareholders do. Now, you know what? D should only be the answer. Well, but they are still receiving return. So, okay. So words are a bit complicated here, but if you think about it, that debenture shareholders have also are also receiving a fixed return. Although the words are a bit problematic here, because debenture holders are not really, getting a return. They're getting interest, but it kind of means the same thing. So we can go with the C. We can go with the C. That's a reasonable option. Again, but the words are a bit confusing. I'm pretty sure that some of you got confused as well between the two options here. 24. Every member of a sports club is required to pay an annual subscription of $50. The subscription account shows the following. So in the beginning we have well, it's an income account. We know that. It's an income account. Debit balance means accrued income. Okay, so there's some accrued income. We received some during the year. This was transferred, means this belongs to the current year. Okay. What's the question? What was the increase in the number of members in arrears between 1st January and 31st December? Okay, so number of members in arrears means who paid in accrual basis. You know what I mean? So those who have not paid yet on 1st January is, well, 350. Each of them is $50, so that's going to be 7 members in the beginning. And at the end, how many members are there? 750 divided by 50, 15 members. And so previously, 7 members had not paid their amounts, but now 15 haven't. The increase over there is 15 minus 7, that is 8. 8 members. So 8 more members have not paid their money this time, have they now paid their subscription fee this time. Let's move on. 25. Which term is used to describe the surpluses which have been earned by a club over its lifetime? Okay, just by definition, that is accumulated fund. Okay, retained earnings, capital, these are not terms used in club and societies. And this is not during a lifetime subscriptions, it's just during a particular year, right? Uh, yeah, that's not what they've retained throughout their lifetimes. 26. NULA provided the following information for the year ended 31st March 2021. What was profit or loss for the year? It's a very beautiful question, repeated every time. I've given you a formula for this, and remember, don't forget this please, net assets mean the same thing as capital. It is literally the same thing. Net assets means assets minus liabilities, that's all, right? So that is opening capital, closing capital. I've given you a formula in the past videos. You can watch them, there are plenty of them. It'll help you out. If you haven't, you can just go back and watch them before your exams. So the formula goes something like that. Opening capital. I call it magic formula. There's no such thing as that, but I just name it. It has to have a name, right? Opening capital plus profit, or minus the loss, if there's a loss, plus capital introduced, minus drawings, equal closing capital. So that's basically the journey of opening capital to the closing capital. So we have some capital in the beginning. We add the profit to it during the year, or subtract the loss. We add any capital introduced and we subtract drawings. Because there are things that increase the capital, profit and capital introduced, and there are things that reduce the capital, loss and drawings. And then we have the conclusion of closing capital. In this case, what do we have? We have opening capital, 6,500, plus profit or loss. We need to find that. Let's just put X. Minus drawings, 3,900, equal closing capital. That's all we have in this question. 72 to 75. In other questions, we have different details. X equals 72 to 75 plus 3,900 minus 6,500. Very basic algebra. I'll just put that in my calculator. 72 to 75 plus 3,900 minus 6,500. 15675. 15675. It's a positive answer. Tells us it's a profit. That's why I didn't write profit or loss here. I just wrote X, because if we get a positive answer, that's profit. If we get negative answer, that's loss. Let's move on. Number 27. A trader who does not keep full accounting records was able to supply the following information. Just by looking at the detail, you should understand that they're talking about total trade receivables. Just by looking at the nature of that information. How much were credit sales? Well, okay, so we will prepare our trade receivables control account, and that should give us the answer. Don't even have to read the question properly, really. That's how obvious it is. So let's make the approach I like to do. The approach I like to take is to make a little T account. So opening trade receivables are 3,000. Okay. Checks received from trade receivables, that reduces the trade receivables, right? That reduces the trade receivables. Bank debit, trade receivables credit, 28,000. And this is, by the way, trade receivable control account. Or actually another name is sales ledger control account. It's the same thing. Total trade receivables, sales ledger control account. Well, there's no such thing as trade receivables control account. It's sales ledger control account, but total trade receivables. Total trade receivables. Okay. Bank, when you receive money, receivables go down. When cash discount is allowed to your customers, again, the receivables go down. You're not going to receive that amount anymore. Amount owed by trade receivables, that's the closing balance. So what about the sales? Well, when you make credit sales, that's going to increase the trade receivable. That'll be the X. We don't know that, right? Sales for the year. And we also have the closing balance carried down. That's the discount. The carried down balance is 4,200. Okay, that's all. And now once we just need to find X by balancing this account. 28,000 plus 1,500 plus 4,200. So that's the total, 33,700, 33,700, 33,700. And X, the missing figure, will be 30,700, right? There, D. 28. Margin markup question repeated a lot of times. Let's see. A markup of 25% is applied. What were the purchases for the year? Okay. Revenue is given to us. Information about opening closing inventory is given to us. The question is about purchases. You see, whenever you see opening inventory, closing inventory, purchases, this should remind you of cost of sales. And since we are thinking of cost of sales, we have the revenue and we have the markup, you make the table. What table? The table that involves this. You can memorize this if you want. Revenue, cost of sales, gross profit. Revenue is 120,000. Cost of sales, we don't know. Gross profit, we don't know. What do we know from the percentages? We know markup is 25. Markup means gross profit as a percentage of cost. So it's 25 of the cost. 25 out of 100 of the cost, right? If cost is 100, gross profit is 25. And that makes the revenue to be 125. Does that make sense? In terms of percentage units. We're looking at percentage as units. And now basic algebra or basic maths, basic ratio maths tells us 120,000 divided by 125 will give us value of 1 unit. Multiply that with 100 will give us value of 100 units, that is represented by the cost. 120,000 divided by 125 times 100, 96,000. Okay, we get out the cost. And now we can simply put the purchases as a missing figure. Opening inventory plus purchases minus closing inventory gives us the cost of sales of 96,000. Purchases equals 96,000 plus 10,200 minus 9,600. That's 96,600. Yes. Question number 29. George provided the following information. His liquid acid test ratio was 1.2:1. What was his bank overdraft? How do we calculate acid test ratio? What we do is we take the current assets excluding the inventory, that is trade receivables only in this case, that's it, over trade current liabilities, which is trade payables, and apparently there's also bank overdraft, which is not given to us, whatever that is, bank overdraft. That equals 1.2. That's what they're telling us. And now we just need to find x, right? So 18,000 equals 12 times 8,000 plus x, can divide by 12, 18,000 divided by 12 equals 8,000 plus x, 18,000 divided by 12, 1,500, 1,500, let's subtract 8,000 equals x, 1,500 minus 8,000. Oh wait, I think I messed up somewhere. Oh, wait. What did I do? That's 1.2, not 12. Okay, sorry. 1.2, 18,000 divided by 1.2. That's 15,000. 15,000 minus 8,000 is going to be x. 7,000 equals x. Okay. Next question. Number 30. A trader provided the following information. Revenue. Okay, so just trading account or the trading section in the income statement. It was found that the closing inventory should have been 4,000. Okay. Remember, closing inventory reduces cost and increases profit. What was the correct rate of inventory turnover? Okay, how do you find inventory turnover or rate of inventory turnover? You do cost of sales over average inventory. Okay, so cost of sales is going to be, let's calculate, opening inventory of 100, right? Plus purchases of 2,600 minus not 300, 400 minus 400, right? Opening inventory plus purchases minus 400. That's 2,300. And the average inventory is opening inventory plus closing inventory divided by 2, 250, right? 2,300 divided by 250, 9.2. Done. 31. Yeah, that's 31. The current ratio of x is 2:1. The current ratio of y is 1.3:1. What does a comparison of these ratios show? X has fewer liabilities. We cannot say that. No, because it's comparative. We don't know. It's a ratio. Maybe they have more liabilities. like monetarily, you know. X has more liquidity than Y. We can say that because that's what the ratio measures. Probably. Y, I mean, probably that's the right answer. I don't think we'll have a better option. Y has fewer current assets than X. Again, we cannot talk in absolute terms, right? We don't have the numbers. We just have the ratio. We don't know which one has more or less. Y has more inventory than X. Now, current ratio would remotely not even talk about inventory alone. So no. B is the only best option we have. 32. Which external parties would be interested in financial statements of a trader? A bank manager considering a request by the trader for a loan. Let me read that again. Which external parties would be interested in financial statements of a trader? A bank manager considering a request by a trader. That sounds okay. Sounds good. A trade union seeking a wage increase for employees? Perhaps yes, because they want to check if the trader can even afford to pay that. The business manager making, that's an internal party, right? So that should be wrong anyway, because external parties is the question. Make sure you read the keywords. The trader deciding if drawings could be, again, that's an internal party. So 1 and 2, B's answer. Sabina runs a retail business. She plans to close her business in a few weeks' time. How should her fixtures and fittings be valued in the statement of financial position? Okay, so she has planned to close the business. That's confirmed, it seems. And when that is the case, right, when that is the case, you have to adjust your assets at their expected sales value. I've noticed that they have increased the number of questions of this kind. So make sure you understand that concept, right? That idea that when it is confirmed that the business is closing down, then you have to adjust your assets at a fair value. You have to put them at a fair value. Okay. 34. Why should a trader match his costs for a financial year with the revenues for the same period? That is the matching principle, first of all. Then let's see, let's have a look at the options. To account for all the liabilities, um, very vague. We'll see about that. To account for money that has been paid in advance. To make sure outstanding income is included. To show correct profit figure. Okay, so the others are a bit linked, but I think D is the best option because this is like a generally right answer because like that's the main idea, isn't it? That's the main idea. Although the others are also pretty linked, isn't it? To account for all the liabilities, a little vague, but it's linked to the answer. To account for money that has been paid in advance, that is also so. All of these are matching principles, but you know this shows the application of it like that. You know that shows why a trader should, right, include that. So yeah, D looks like the best option, although a little confusing. But you see, this is very specific, a bit vague, and this is seemingly the best option. 35. Which international accounting objectives are described by the following statements? Information in financial statements must be free from material error and bias. And so it makes it reliable, right? When things are free from errors, you can rely on them, you can trust them. So they're trustworthy. Reliability, I believe, is the right option, and two of them are removed now. The user must be able to identify differences and similarities between information in different financial statements. And so that should be comparability, right? Yeah, because obviously they should be able to compare them. That's what they're talking about here. And that's it. I felt like this was one of the easier papers. Actually, I feel that after every paper almost, but this one actually was a bit easier than what I've seen in some other 2020 papers. I don't know if how many of you have made it till here, if you're still watching, but if you have made it till here, good luck for your exams. They're coming up soon in a few days time. So yeah, good luck with that. And don't forget to share this with your friends, subscribe to the channel that might support us. And yeah, thanks for watching. Have a nice day. Goodbye.